Gold has been around for thousands of years, but actually only very recently has been a staple in investment portfolios. Gold acts as a hedge against volatility. If you see a spike in volatility in the market, or a correction or a stock market crash, that's good for gold. Gold's performance has been not as stellar as some people might have predicted, given what's happened in the stock market. Typically, what happens when we've seen a panic or a stock market correction before is people don't immediately flock to gold. And the reason for that is they're trying to assess the situation in their current portfolios and maybe having to liquidate assets in order to meet redemptions from clients. We saw this in 2008 in the great sell-off that happened. Gold actually initially sold off along with the rest of the market, but then subsequently recovered and obviously finished up positive for that year and then went on to post an all-time high a couple of years later. The initial process is that gold typically doesn't react at that particular moment, but follows through afterwards when people start to allocate capital as their perception of the market changes. Fast forward to today, the best is yet to come for gold. The last 30 years of disinflation is now over, and we are beginning a new inflationary phase that is positive for gold and positive for commodities more broadly. Gold acts as a hedge against a rising inflationary environment because the supply of gold can't be readily increased like the supply of money. One thing to consider when investing in gold ETFs is whether it's backed by physical gold. Physical gold that is not allowed to be lent out, but is also audited by independent third-party inspectors. You just never know what's going to happen with financial markets. One minute the market is performing very well, the next minute it may not be so. You need something that's uncorrelated to the rest of the market that would add value in investors' portfolio over the long run.